All right. Good morning, everybody. These are the spot gamma levels for today. Just pause the screen there for a minute so you could take your screenshot. All right. So it was a really interesting FOMC yesterday. Powell was out there saying there's nothing wrong, critically wrong with the system. So we don't see any reason that we need to start talking about cutting rates. We're not going to cut rates this year. And Yellen was somewhere else in the world having an interview where she was saying this is a really critical situation. We need, the government to get that debt ceiling raised. We got a crisis on our hands, and if anybody does a bank run, it'll just implode a lot of banks. So on one side, it was, hey, we need help, and on the other side, we don't need it. Everything's fine. There's nothing wrong. The market obviously doesn't believe Powell, which is using backwards looking data, and is saying we're not going to cut this year. The markets are pricing in 3 cuts by the end of this year. So a big division between what the Fed is projecting and what the market is projecting. That puts us kind of in the same boat that we were in before the FOMC, where we really don't have a narrative to follow, and we've still got a sideways market. I've been saying now for over, well, all year that this is supposed to be the year of the sideways, and so far that's exactly what it is. So it's just going to be same old for now. We do have ECB and BOE speakers that came out and really didn't shake the boat too much. They'll be back again. We've got 10 o'clock and 11 o'clock speakers again. We do have additional auctions, some jobs data. All right, so we can see Asia closed well. Nice expansion candle. They're coming out of that IX10 pattern. Not quite to the point where we're getting a breakover on the trend line, but this lines up really well with a failed flag play. Europe, on the other hand, while the day isn't done yet, they are inside day breakout to the downside, still sitting inside of March 21's candle. That is now the candle of control. IX10 is in effect. We look for this to close today above or below 50% of the 21st. Right, so mark that candle, cut it in half. This fade back will either find support at 50% and begin to rally back up again, in which case we'll keep our bullish posture, or it breaks 50%, closes below it on the day, and we continue to look for continuation shorts. Brent and crude still not back inside that channel. kind of flirting with the bottom of it. You see, we tagged it, came inside of it yesterday, wasn't able to keep it and came back down again. So we're inside day. It's a really wide day. And so far, we're just maintaining inside of it. This is what we have at the moment in a lot of places. Okay. So we need to see the follow through on that. Shush. So as you can see, we got a lot of auctions today, including the 10-year tips at 1 o'clock. So a really full house, but once you get past 1 o'clock, whatever we got for the day should be fine. And your 0-day plays after 1 o'clock really shouldn't have any issues unless somebody comes out chipping their teeth, right? And they've been in quiet mode for a while. They might want to finish the week, maybe take a few days off and come back over the weekend, maybe watch for a what they call a full Ginsburg. That's an old school kind of hat tip to Ginsburg, who went around all of the major media networks on a Sunday and hit all of them in one night, trying to get a message across. And ever since then, it's been called the full Ginsburg. So watch for one of these Fed officials to try to pull a Ginsburg over the weekend, Sunday night, hitting every single one of the top shows with a consistent, persistent message. Otherwise, if we get through the weekend without any of them really breaking a tooth off, then the messaging probably will start next week. And make no mistake about it, there's going to have to be a messaging solution here, because we had two different sides saying two completely different opposite things, and the market has no idea what to do. So they're going to have to huddle, put their playbook together, come up with a theme, a consistent message, and that's the narrative they'll start pushing. You want to start looking for that narrative to form. Volume's a little light today compared to what we would have maybe expect after an FOMC, but it is within our range that is considered normal. So between 100 and 200, we would be normal. It is normal. We're done with this thing. We can turn it off. So as you can see, we're still inside the box. This chart goes back to the first of the year, January 3rd. And, if you look at where we've gone and what we've done nothing. We've gone nowhere. It's the year of the sideways. 3850 is the low end right now, and 4050 on the high end. It's a reasonably decent range. We're in the middle of it. And as I usually say, beat the drum, don't diddle in the middle. So if you're not in a trade and you're looking to get into some swings, kind of need this to resolve itself. Get to the top and reject, great, we get some shorts. Get to the top and break out, great, we can run some longs. Break a major trend line, we can run it to the downside. Run it back down to the bottom of the box. Otherwise, from where we're sitting, we really got nothing. If you look at it on the daily, we're sitting inside of yesterday's candle. We got nothing. And yesterday's candle is a really big candle. Normally when we're inside day, we start looking at compression plays, maybe setting up for, a move out of it with conviction. But when we're inside day and the previous day is just this really big, massive candle, there's no implied impression or compression to any of this. So it needs to get up and do something. $21-day ADR is at $75 or 1.8%. That's the average daily range right now. We're back inside the previous week, so we weren't able to keep the inside week breakout. And we do have an MDP, although price is working on getting that closed. MDP would be a missed daily pivot. We haven't hit it yet, so we're kind of working on it. Keep in mind that the sell-off going into the close yesterday is a lot like a gap that needs to be closed. And I know there's not a gap. You can see the candles there. We're talking more of like a liquidity gap. Markets very often will close this sort of gap before doing anything else, or it'll give up on it and really push the continuation of whichever direction the gap started. So until we get back up to 40.40, it'll be front and center to me, everything that we would want to focus on. And that yellow line that's running there at 40.36, that's the RTH open of the previous day. Now 40.40 hasn't really been a level that we've been focusing on a lot, right? If you look back at all the gamma levels and put walls, call walls, all that, 40.40 is not a level that we generally focus on, but it just recently started becoming a level that spot gamma is highlighting. So now it's in focus. Otherwise, there's the cog line at 40.31, 40.11. Then there's tier 1 alpha and spot gamma with their round numbers and quarterly levels for your large gamma, call wall, zero gamma, combo levels. And they're the same levels over and over again. They don't really change. Just 40.40 happens to be something that has recently been added in. So we could see 3998. It's one of those major voodoo levels. And 3933. But we got a cog line at 3931. So we just kind of overlap those two. Getting above this voodoo level is going to be the #1 focus right now if we're looking to try to reclaim this gap. There are more minor voodoo levels: 4013, 4022, 4037. $10-day, 30-minute volume profile. When we're at the bottom, we expect to go to the top. When we're at the top, we expect to go to the bottom. We're starting to get a difference between the TPO point of control and the volume profile point of control. Volume profile still at 39.50, so it's a major level. We want to keep our eye on 39.50. It will become a gravity point if we continue to not get this gap closed up here at 40.40. I don't really want to say that it's support, but it's a lot of volume down there. So think of it more as an area where we would expect price to really respond to a previous structure. Right, so first touch bounce, maybe a struggle to get through there. If we do break below 39.50, it does get kind of shallow, but then it just got a lot of trash again. The main takeaway from this chart right here is that getting below 3,900 would be really, really difficult. Price action alone won't be able to do it. There's going to have to be a catalyst, something news-wise or event-wise that takes us down below 3,900. Spot Gamma says that on the SPX, 3,900 is a large gamma level. On the ES, it doesn't have anything listed for 3,900. 38.97 is a combo one. It's close enough to 3,900. And 38.40 is a put wall for the ES. So it'd be the lower end of this volume profile. All right, 5-day, 5-minute volume profile. We did take out the VPOC yesterday, ran right through it like it wasn't even there. And now we have a VPOC overhead. At 40.32, 40.31. I bet if we zoom in, it'd be something really close to that. 40.31 is a cog line. 40.32. It's one of those voodoo levels. So close enough. There's just a lot of stuff right there. So you can see how the market, the more we spend in this sideways situation, the more of these levels we're going to continue to build more and more and more. And it's going to make it harder to get out of this. Obviously, at some point, we're going to get out of this. So we got outside the box earlier this week. Now we're back inside the box, but we're still holding higher than where we opened Monday. Or say it another way, we're still higher than we closed Friday. We are right at the 10-week. I mean, we're there, we're on it. The phrase that comes to mind is, let the games begin. Like, we hadn't even started yet, but we're ready now. Center of the court, we can go either direction. We could expand 4% at easy, above or below the 10-week. from this point right here. So even with all of the moves that we had yesterday, we're not overbought, we're not oversold, we haven't moved too far. It doesn't owe us a rebound. And we're right at the start of the show. We haven't we're not above or below or anything. We're just there. Looking at the 10 day instead of the 10 week, we're just slightly above it, a little more than 0.25%. Now on the year, we've gone 2.5% and 3% multiple times within the last year. So, you know, if we were to expand to the upside, we've got plenty of room to do it. And for the downside, I mean, we're not even below the zero yet. So an easy 2.5%, 3% move, which again shows we're not overbought, we're not oversold, we haven't moved too far. It doesn't owe us a bounce. All right, we're looking at the dollar here on the daily. $106 and a 101 are a really big deal. So at some point in the later part of the year, last year, we started to get this disconnect again from the inverse relationship of the dollar and the S&P. Through most of 2022, if the dollar went down even a little bit, the S&P went up. And if the dollar went up just a little bit, the S&P went down. They were really tightly correlated in an inverse situation. That finally decoupled in the later part of the year last year. So now the dollar can still put pressure on the market. It's still in an inverse relationship, but now it's more of a level that it needs to get past rather than just, well, it went up, let's see the other one go down. So 101, maybe 102, but I wouldn't give it that much room. I'd give it that 101. Dollar below 101, you're going to see the S&P continue to leg up, try to get through that 4,200 zone. Dollar back above, say 105, but more likely 106, then we're going to see the S&P very likely break down below that 3,800 or at least 38.5. All right, so we're trying to run more of you know, like if then levels. I've heard it called swagging, but you know, that's not my phrase. I don't really want to use it. So 106 and 101 are the obvious levels. I think tightening that up a little bit to 102 and 105 makes more sense, because the overshoot that we've seen from 105 to get into 106 and the overshoot below 102 that puts us down into 101 were the edges of where the S&P was overshooting and then coming back in on the other side, right? So say getting down below that 3,900 when this got above 105, but then rebounding when we hit 106. We've seen the S&P come back up as this went back down. So we're flirting with that 102 this morning. It's kind of the point. Just getting below it like yesterday where we wicked it down and then came right back up, that's not really what we're interested in. We want to see a solid definitive close below 102. And or we want to see with conviction that we leave the bottom of this zone and start working our way back up the box. Two massive indecision candles here, and then one very small indecision candle, 3 in a row. The market just has no idea what the heck it wants to do. And don't forget, we've still got a lot going on with BOJ in the background. Bank of Japan is still a really big deal that needs to be dealt with, or that is on the horizon that still hasn't been dealt with, to say it that way. So it's not that we don't want to watch the dollar. It's more of the idea that we want to watch the dollar at key levels, kind of lines in the sand. And as long as the dollar continues to chop around inside of this box, the S&P also is going to continue to chop around inside of its box. All right, when we were seeing the 10-year, getting up into 4.1%, that gets into things breaking level. But obviously we came off of that with conviction. Getting below 3.3, someone much smarter than me has said that this would be a deflationary impulse, right? It would be a really big deal we get below that level. We're not there. We came up off of that threat level the other day, and we're sitting in this chop zone. Same thing with the dollar, right? We're just sitting in this chop. So as long as TNX continues to stay in this chop, we're going to continue to see the S&P in the chop. This has to resolve one way or the other. It's got to get below that key level of 3.3%, or it's got to get back up and break out above 4%. Anything else that we do inside of this is just going to be noise, chop, whiplash. I think that sums it up nice. If the S&P can get above that 4,100, the market's going to straight up get bullish. And if we break below that 3,800, then we're just going to really get bearish. Anything in the middle of that is just going to be chopping and noise. Well, for that same thing will be the dollar and the TNX stuck in this range. We got TLT here. Same thing. Exact same concept. Now you might be thinking, well, this is all redundant, that, they're all three in a range. So why are we looking at them? One of these is going to lead us out. It's very likely that the S&P won't be the leader. It'll be the response. So, yields lead us out, bonds lead us out, and then the S&P responds to it. And it could be the dollar that leads us out. It'd be one of those three. For TLT, it'd be 109 on the upside and 101 to the downside. Nat gas, biotech, and technology, and gold have a really high sizzle this morning. The China ADRs that we watched through the ETF KWeb, things up over 4% this morning, which will bring in like PDD, excuse me, JD, Baba, Baidu. The Bitcoin proxies doing really good. Careful, there was some news on Coin. Coin is down, but the rest of them seem to be doing really good. And banks. So those are 3 different groups, right? It's the China ADR group, the Bitcoin proxies and their group, and then all those banks that got kicked in the face. That's 3 different collective groups that are all bullish this morning. And their ancillary effects spread out into a lot of other markets, right? It's like just throwing a rock in calm waters creates the ripple, right? Well, these things are creating a bullish ripple across the rest of the market. We very well could see a short squeeze start to kick in, and that would start bringing in those Wall Street bet names and you know, your meme stocks. Yeah, the thing that's going on with coin, the reason I bring it up is it's not a quote Bitcoin situation, right? If it was, we'd be seeing Bitcoin and the Bitcoin proxies getting whacked across the board, and that's not the case. The situation with coin is 100% a situation with coin, and so far it isn't bleeding across in any way to any of the Bitcoin proxies at all. Take a look at BITO. This is the Bitcoin ETF. You know, it's up a little bit this morning. The BTC, Bitcoin futures, right, also up this morning. So it's not reflective of anything other than coin having issues of their own. The rest of them are doing really good. Mara, Riot, GBTC, and the BITO. So a lot of those chip names, they fall into the Bitcoin more through blockchain, but not just because of blockchain. So AMD, NVIDIA, Taiwan Semiconductors, But a lot of the market right now is sitting in this same situation, right? We got this bullish Haromni, and we got to follow out of that. We got to get across it onto the other side. Anything that wants to get bullish has to get through this big, massive red day from yesterday. So KRE is still holding that support level that it hit, which goes all the way back to like 2020. It's this gap close from back here, no, October gap close, so weekly, no less. 41.86. You know what? That gap isn't closed, which is a little bit of a concern. It wouldn't surprise me if we get down there and hit that thing after all. We still need to see the effects of what Yellen was talking about yesterday. So for the KRE and the names in it, those individual names are very likely going to respond better and recover better than the ETF is. When we talk about something that kind of owes us a move back in the other direction, all of those, right? All those financials that dropped really hard, really fast, they're very likely going to get a short-term rebound. But don't mistake that rebound as a recovery, because that's going to be a completely different discussion. So there are times where a leap is a really good idea, or at least maybe say it another way. There's sometimes where a leap makes sense, right? And in this kind of situation with the banks getting this significant beat down, going out a year or say a year and a half on something cheap like XLF, selling some puts down there, it's not really a bad idea. Right? I don't think that I would necessarily want to focus on individual names unless you trade this space often and you've got a really comfortable knowledge of each of these different banks and trading firms. And right, if that's the case, then yeah, sure, go ahead and take that route. Me, the ETF XLF probably be a better way to go. Right, we're talking about a year or two out, and being comfortable with the idea that what if you actually ended up with these shares, right? Say $25. And if that really doesn't bother you to consider owning these shares at $25, then wow, that's a huge spread. So we go out to like June of 2024, the spread gets a little bit better. It just gives you tie up a little bit of capital, throw it on there. Um, and it's the idea that, financials are going to bounce off of this at some point and begin their recovery. You give it a year or two, ties up a little bit of capital, and worse comes to worse, you end up owning the shares and you sell calls against it for a while until you get back to a break-even status and you unload the shares again. To kind of resolve some of the bid-ask spread madness that's in here, if you were to bring it in closer to the money and say sell 31 strike puts for 320, which would be the mid, subtract $3 from 31, that'd be your break even. That would basically be your stock purchase price. I know it says, you'd get assigned at 31 if that's what you sold, but dollar wise, you'd already have collected 320. So your average share price would be lower. Oh, yeah, and hey, make no mistake about it. I'm not saying that this situation with the banks is done. Yellen made it very clear yesterday that it's balanced on a needle, and all it would take is for Americans to spook and make a run on the banks, and it would take the whole system down. Banks don't have your money in the bank. That's not the way the system works, and most Americans don't know that, because our schools suck and don't teach people how to manage their money and teach them about finance when they're in school. So you get people scared and make them go to the bank and get money out. 2 or 3 people do that, it's not a big deal. Half your town does that, there goes your local neighborhood bank. So the banking situation is still a tenuous situation, right? All we're talking about here, which is why I said focus on the ETF and not the names of the companies on the individually. This is the XLF. This is a quarterly chart going all the way back to 1999. Think about the 07-08 bank crisis, right? The Big Short movie, where it dropped from $29 all the way down to $5. And still, we came back out of it. We're talking sectors, ETFs. XLK, XLI, XLE. Even at the worst of things from 1999 all the way on. The lowest this thing got was $19, right? So when you're talking sectors, just like the indexes themselves, the Qs, the S&P, the IWM, it's the marketplace. The market always goes up. It might take half a decade, but it's not like Yahoo stock. It's going to disappear someday or go to zero and leave you as a bag holder. All right, so Tesla had this gap up on the 21st, and it set our standard that we got to keep an eye on. We're below that 50%. So that's a big deal already. Oh, we were below it. It's rallied back up out of it, which kind of causes a little bit of concern. It's always a little tricky when we've got a line in the sand like this 50% line, 193. We got below it. We closed below it. That should have negated the run, the breakout, the continuation for this upside move, except the sell-off yesterday was news related. And we have to consider the gap close that I mentioned earlier. This is a gap that needs closed, even if you see candles there, right? It's a liquidity gap. Well, it has closed it. It came up in the middle of the night or in the pre-market this morning, and it closed that gap. So how we close on the week really is going to be much more pressing on a lot of these names, because we need to fix this big move. The way stock charts would talk about it is that the charts are damaged now, right, from this really big move from yesterday, and it needs to heal that damage. So we can still trade it, but we are not going to be able to rely on things like 50% of this candle. That's not going to help us out. What I would focus on today is getting outside of yesterday's levels, either in an upside or a downside, and that's going to be really hard for most of these names. On Tesla, if we can break above yesterday's high, that 266 cents, there's a gap to close at 202.77. That would be my upside target. To even begin to kick that off, I'd say we'd have to get above that 198 just for at least a starting point, right? 198 would be the inside breakout of March 21st. So if we can get above that, we can start the trade, maybe add to it. If we can get above 200, the target would be the gap close 202. Otherwise, a break below or a break out of yesterday's low gives us a chance to target the low of the 21st. So 187.65. $188. And then the gap close 183.25. Now there's no setup, right? We don't even have a Haramni here. 276.56 is the top of 316 candle, this big monster candle right there. And 263.28 is the bottom of that thing. As long as we're sitting inside of this 1 day massive candle, Microsoft's got nothing. Now there's enough room to make a little bit of money chopping up and down through here, but for the bigger play, we got to get out of that box. That was a pretty wild reversal on this thing yesterday, and it closed just like everything else did near the low of that day. And we're getting a little bit of a rebound now in the pre-market. But still this significant level, the one in pink, 276.76. It's still a massive line in the sand, really hard to get through. And these big wicks up here shows that there's still a lot of liquidity. We haven't been able to resolve it all. We don't know how much more is still up there. And that every time we get up there, there could still be a big seller just sitting there waiting to dump shares. Now, Apple's a little bit different. It's really close to this 159.15. It's the orange dotted line here. We've got multiple open, high, low, close pivots, right? What I call institutional pivots. It's the close of this day and the open of this day. So if we can open above it, which right now we're above it, just barely, but we're above it, then we don't have as much resistance in Apple as we do in, say, Microsoft. So inside day breakout in this, much more likely than, say, Microsoft. And the gap close, or at least the next target, would be that 165. %42 of the S&P is up this morning, 0.5%. 44% of the NASDAQ is up 0.5%. And we've already talked about what a lot of those names are, right? There's the China ADRs, the Bitcoin proxies, and the financials. Well, that's great. Those are the financials being the key one. That's one of the key risk on sectors we need for a bullish day. But we need to see those FANG names come in, right? Apple, Microsoft, NVIDIA, Google, Amazon. Finance alone, I just don't think that it's got enough juice to carry this market. It can hold it up and maybe stop it from crashing down lower, but I don't think it's got enough to break us out of these significant resistance levels that we have. So we need tech. If we don't get it, I don't think this rally is going to stick. And after such a violent week with so much indecision, it wouldn't surprise me if the market just holds for the rest of the week in this range. So here's the pre-market change. The monsters of tech stand out. They're the biggest boxes. Amazon, 1.5%. NVIDIA, closer to 2%. Tesla 2%. So it looks like we got tech. We can't use like NY Fang because it doesn't give us anything until the market opens. But looking at the pre-market at the names that are in that thing, it's up, right? We got banks up, tech up, Bitcoin proxies, China ADRs, everything says bullish. And it's not runaway bullish, right? At least not across the board, to where most of these names, they're not reflective of an index that's up 2.5% this morning, something like that. We're mildly up in the indexes. I think there's some pretty decent levels right there. Each one of them just a goalpost or a sign to get through, right? You get to that one, get above it, stick it, get to the next one. There's just a lot of damage that needs to be resolved. And this rally back up this morning off of the lows, it might feel bullish, but if it's nothing more than a gap close, we're going to continue to move to the downside. And that's something really important to kind of take away from all of this. The rally up this morning could be nothing more than trying to close that gap in a lot of names. It's just the idea that with all of these different sectors and subsectors and industries all making a move this morning, like the K-Web constituents, the China ADRs, the Bitcoin proxies, those are liquidity tells, and liquidity is showing bullish, 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 bullish. So if we break below the low of any of these names that we've looked at, the low of yesterday for Amazon, Tesla, Microsoft, Apple, SPY, any of them, the game is on to the downside, and all we need is a candle close below, say on a 15-minute chart. So that pretty much sums it up. We've covered the dollar, the 10-year, the TNX, TLT, and all of these sectors this morning. Bullish till it ain't. If support, which is yesterday's low, fails, then expect it to be a tidal wave to the downside. Otherwise, we're in a short squeeze, and we should start to see things like ARK and those meme stocks also get in on this and just see everything kind of rally back up. Keep your eye on energy. It could be a tell that kind of comes out of left field. Something like USO or CL, if you want to use the futures. Other than that, everybody be careful.